futures options ahead of a big event like this is very expensive. You cannot buy calls or puts without putting up a large amount of money through premium, unless you do one of a more constructive way of doing it. You could do, you could buy an iron condor. There's different ways to do this, or you could buy a put or a put debit or a call debit. All these different ways you could do it. But my point is just this: options are very expensive right now. What you have to pay in order to get, it's kind of like in Forex, the spread goes super wide. It's the same thing in options. The market maker widens the spread dramatically on Forex pairs right before major news events. Same thing with options. The options market widens, quote unquote, their spread in the form of premium. So my point is, everybody's out there buying puts right now, just super aggressively. And I just think you got to be careful with that, because when everybody is convinced the market's going to do something, even if the market goes sideways, all those people who are buying puts and calls are going to lose money. That's why the market maker makes the money most of the time by selling options, because they sell those juicy premiums to the people and they collect the profit. Most of the time, not always, right? There's times where options make a lot of money for people. If you're long puts and the market tanks, or you're long calls and the market rips, you can make a lot of money. But most of the time, options actually expire worthless. So it's really something to think about. Anyways, guys, up next, we got Chris Pulver taking over the show. He's here to go through this key market event. I got to hop off. I'm going to run and get started on some stuff here today. But before I go, let me just remind you, the Edge Finder discount sale is going on right now. It's our anniversary, the 3rd year since we launched the tool to the public. And to celebrate, we're doing 45% off the Edge Finder. It's our biggest discount that we do all year long. Don't miss the opportunity to pick up a copy for yourself if you're ready to take your trading to the next level through our sentiment analysis, fundamental analysis, and technical analysis tools built for traders. Don't miss it. Again, 45% off. Use the link right here. Up next, we got Chris Pulver taking over the show just after this.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else, and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What is happening, everybody? Happy Wednesday. Happy pre-Liberation Day. Let's find out at 4 p.m. Markets for the day, gap and lower. Bulls coming back to fill, maybe some chop suey up in here. My blue levels are some of the sells that I've got on SPX this morning. So looking to see if price will stay within range. My immediate thought in the day would be that this market stays relatively calm through the day with the uncertainty that lurks after the bell. This is not a great thing, but if we have the market drifting higher for the day with little to light volume, my concern is after the bell into the futures market into tomorrow's day, either this is another rip higher or volume returns and we're going to revisit the lows. That's the reality of what we're dealing with. Like, I don't know what direction is going to be. I would say that I'm getting some rumblings that Israel has backed off on reciprocal tariffs. Canada says to remove tariffs if U.S. does. So we could have, this is possibly part of the art of the deal, which is you want to get people to negotiate. You make all these threats, and all of a sudden it comes down to having this deadline, and we'll see who. Okay, so is Canada removing tariffs? No, but if the U.S. does, then they will. Now, is the U.S. going to remove tariffs? Probably not, but there's going to have to be some type of maybe middle ground, which I think the market would actually like. We'll see. Anyway, I don't want to sit here and speculate on. It's 4 p.m. That's when Trump's going to talk. That's when it's unveiled. It could also be like country by country. It could be like a blanket tariff policy. I really don't know. I read an interesting, there are a couple good points this morning. Let me find it here. So basically, anticipation has been turning from, look, everyone is anticipating a Trump victory, and you can see what the markets did last year, right? It bumped. But now it's more like the angst and the apprehension is what the market has been feeling. So, what is going up is getting squashed back down. What is going down is potentially dealing with, like, there's more pressure to the downside, I think, than any time in the last probably couple of years, because we've obviously come out of a very nice bull market once we bottomed out in 2022. So there's still a lot of work ahead by the bulls. There's clearly, levels that the bears can claw after. On the bigger picture, I mean, I talked about it this week with that Q1 move when we closed back above on Monday. A couple things I looked at from a higher time frame is, here is my relative strength. Okay, and I'm using a 14 period and a 21 period, and both of those were hitting oversold territory on the daily time frame. This is SPX. So we have a low in price, a slightly lower low in price. We have a crossover on MACD, and we also show that relative strength is showing some hidden bullish divergence. That's a good sign. On top of that, the one thing I also noticed down here is my money flow indicator showing that the 15-day, 20-day still showing some money flow to the upside. So to me, that's important to see. If we have money flow with volume, then perhaps we can come back and pull back into like this bull flag, or it'd be a bear flag. But if this is high, low, and this market comes back up to the same highs again, we may set up for a bear flag, but at least in the near term, we at least have another relief rally. So this allowed me to de-risk. When this market was up for a couple of weeks, I was de-risking and taking off a bunch of trades for winners. If we have the same type of thing with Thursday, Friday, I will probably do the same thing again, and then be more braced for, okay, this market is literally at a decision line. Is it going to be bullish or bearish? I don't know. And obviously we sit here and we're like, it could be bearish, it could be bullish. It also could go nowhere. There could be so much indecision with this market right now that it's not just tariffs and more clarity on tariffs. I mean, we're seeing that the Atlanta Fed continues to revise the GDP lower. The U.S. is talking through a softer labor market right now and a weakening growth outlook. And what hasn't happened yet, and this is what's going to be really important to watch the next couple of weeks as we kick off earnings season, we have to look and see where earnings are starting to fall in place. Are we getting to companies that are at consensus? Are they beating consensus? Are revisions lower, going into like a low bar that's set for earnings season for Q1? I don't know. I would imagine that Q1 earnings are probably pretty rough, and if that comes in with an overwhelming majority of companies that are like at consensus or worse, or like way off consensus, then I think we have an earnings revision, or we have the majority of stocks that are not doing well, and that's also a sign of like slower growth and things that could probably drive the markets lower. We're still at high valuations and high multiples. If we need to see another compression lower, then it'll happen. So I mean, this whole story of like what makes the markets go lower, I think tariffs are kind of in, right? I think the next leg of highs or lows will be based on what earnings does. The Fed's not going to touch anything right now. The Fed emergency level wouldn't be until we probably had like a 20+% pullback in the markets. There's probably no such thing as a Trump put right now. So I think the next real leg of either trying to revisit highs or going to fresh lows is going to be based on what earnings get sprinkled in to show, right? And typically when earnings season kicks off, the first real wave of earnings is going to be financials. So you're going to see your biggest institutions, bank-wise, how are they positioning? What's their guidance, right? I mean, do they omit anything negative? Is it like trying to be rose-colored glasses? I don't know. Or are they going to be honest about where they think things are at? I mean, everyone's been talking more. You see this in the news. You see this trending. Multifamily units are delinquencies are rising. Credit card debt continues to go up. Defaults are rising. Subprime anything is very risky right now. So point is, it's not a perfect economy by a long shot. I think the economy is run hot enough as far as the stock market valuations that we might need a deeper reality check, but that remains to be seen. So as it stands for today, tomorrow, this is what I'm paying attention to. This is the rest of my kind of morning and day to see where prices are at. I think prices are going to be relatively contained today, just because there's no major announcement. I mean, the nice thing is Trump's announcement today is at 4 p.m. That's probably a good thing, because it would be extremely volatile if he announced it during market hours today. So tomorrow could be an interesting day. Futures market after the close could be really interesting. So I mean, looking at the futures market right now, this is really choppy stuff. This is the futures markets. This is ES on top and NQ on the bottom. We had price up, down, up yesterday, and then futures market closes right here at the high and fades the entire night. And here we are this morning, right back up. So is this just a big chop fest in futures? Well, then it's probably a chop fest in the indexes too. Remains to be seen. So if we're just dealing with some noise, I mean, I don't necessarily see ES going higher today without having more certainty and clarity. Here's NQ, kind of the same thing. Came back into some previous lows. Here's the high from yesterday. So do we run up there, pause, and stay indecisive? You know, after market, when futures is still open until 6 p.m., is there a run right there? Maybe, right? Close from 5 to 6. But from 6 p.m. onwards, is there more of a push? Do we get some big futures market moving overnight to get a gap tomorrow? Remains to be seen, but we'll find out. All right. So, like I said, I am seeing some positive signs, mainly with this hidden bullish divergence and some money flow coming back up into possibly a little short-term rally. But that does set up for a pretty obvious bear flag. You know, the bulls are just going to have to continue to check boxes. If the bulls can get above 57, get above 58, get above 59, then sure, there's obviously bullish momentum here. But if the bulls can't get back above that 2-week rally, right? If the bulls can't get above this 2-week rally, which is around 57.87, then the bears can certainly come right back in and sweep it. So this was a very easy to see evening star. And if it does the same type of thing where we get a 1 or 2 day rally and then the brakes get put on and then the bears take it back, that could be like a 1-week push right down to the lows. And you're really no better off other than watching the market give us some short-term volatility. So we'll keep an eye on it. Okay. All right. So watching this for the day. I've got time in my SPX trades. Let's see if market makers do their job. Let's go elsewhere. Let's look top down. So we started out, down. I'm trying to think what the gap was this morning. It was another like close to 1% gap. So we opened up around 0.93% lower, and we fought back to essentially flat. So SPX is flat today. Qs are flat today. Dow is actually up 0.17. Russell is up 0.3. So markets fighting back. It's volatile. So keep an eye on that. Let's go elsewhere. Volatility was up on the day. Let's see if volatility is fading. Yep. So this was all green coming into the opening bell, and it's faded. So open, it was green and then faded. This would be kind of an encouraging sign to see if the VIX can continue to either push lower on the day. We might drift higher, or going into tomorrow and Friday. I mean, we do have non-farm payroll on Friday. So I hope that the job number is adequate and it's not a huge miss because we just have more volatility. But if we can get through the Trump announcement today, market gives us some direction tomorrow, and it can sustain that direction. I mean, I'm speaking for the bulls. If they can actually, wake up and get back up towards like 57.80 to 50.100 on the SPX, that'd be encouraging. But for the VIX, having a persistent VIX that took about 9 to 10 days to flatten out, and then another rise in volatility, does it go back down again? Are we going to see somewhat elevated VIX, but in the teens as opposed to in the 20s? VIX 20s is a little bit challenging, right? We have a lot more volatility, a lot more uncertainty, but we'll see what VIX does. It's going to be pushing lower. This is a natural reverting instrument, so when we go higher VIX, we expect to go down. The way I'd like to trade that, and it's right back down towards those lows again. Part of me kind of wants to take on some shares here. Maybe. I don't know. I keep going back to this. It's like, am I that excited to make even if I bought 100 shares and it goes up $2, $3, I don't get that excited. And I'm also in the wake of, do I want to double down if we have another big volatility event? Not really. So I think I'd rather just scoop this up at a very scary VIX price. If the VIX is up to 30 plus, 40 plus, then yeah, I'll probably take a dip in some SVXY. All right, dollar index. Dollar, I'm looking for the dollar to get a little bit softer. Currency strength chart on the day. We have the New Zealand getting a rip Aussie was and then faded back. Euro's getting a little bit of a run. CAD is softer. Volatility wise, I mean, New Zealand dollar caused some movement. So our, Euro New Zealand retracing, pound New Zealand retracing. This looks pretty good for my New Zealand CAD trade going up. Aussie New Zealand is going to pull back a little bit, but this could be a good position on the Aussie dollar looking a little bit better, New Zealand dollar looking even better. I still want to see if I can scoop up some New Zealand dollar back down to 5,600 or so. But yeah, dollar index, let's go euro dollar. So put in 2 positions. So this is 1. This is pending order 2. Looking to see if the euro dollar gets back to the highs, possibly makes a push into that 117 or that 111.50 area, 111.70 area just before that 112 handle. So trying to get out before this high. That's euro dollar. So I still think dollar index is, probably in the crosshairs for the Trump administration, likely going to have some pressure to the downside. I could still see pullbacks into these pockets, right? Looking for a trend line break, looking for an entry opportunity. Just be aware of the move. I mean, this could be low to high, higher low to higher high. Draw your trend line. If we look like we're breaking trend lines on lower time frames, I don't think that necessarily is the top. That's why I'm taking a small trade on the confirmation and then a retest of that level. So that's why I'm positioning my euro dollar with 2 trades to see if this can in fact go lower. Okay. All right. Gold. Actually, oil first. Oil off the lows coming into this 200 moving average. I still think it's a bearish trade, but likely not going to short oil here, but rather let it go a little bit higher if it can. Come into this area, sell back off towards the floor around $66. That's probably the trade that I'll take on oil, would be a defined risk option trade in the futures market. So I'll be looking to trade CL if that lines up. Otherwise, I'm just going to let oil be volatile. I'm still trading UNG long. This one, I've got a $23 call, which is going to be full profit. So I'm just going to keep selling against it to lower the cost of my debit. XAU, this is gold. We are sitting here with overbought conditions and divergence. I measured this yesterday. 31.24. We did poke a fresh high yesterday in gold. Technically speaking, I still think gold is overextended. This isn't calling the top in gold. That's a terrible decision. The amount of central bank buying and bid, and the retail crowd is still. I don't believe this. I mean, we come here every single day, and everyone wants to talk about gold. So clearly, there is a retail crowd that's interested in buying gold. Central banks are doing pretty well, right? They're buying, they're maintaining bid. This has been a very strong bull market. I still believe it's going to be a reversion at some point. But as I mentioned, I'm not interested in buying more at all-time highs. Okay. I am interested in maintaining the silver position to let it catch up. The gold to silver ratio, we're starting to get up towards those 2-year ranges. So gold versus silver, right? Gold has been outperforming, and this is something to watch. I mean, no, this has been a range for the last couple of years. So is gold going to continue to outperform? And if so, well, maybe we have a little outperformance, but then hopefully that changes. Okay. So if we see gold outperforming, that's fine in the near term, but it doesn't mean that when I say outperforming, it's like, look, gold can go up, silver can go up less. Gold would still be outperforming. But the ratio is getting a little bit skewed to, if this typically balances out, you'll see, silver actually catch the slightly better bid and play catch up a little bit. But if this range holds, which has been the last couple of years, then maybe this pushes back down, which means that gold can still be pausing, but silver can be bullish. We'll see. All right. So gold is doing fine. How many of you, by the way, are still buying gold at fresh highs? I just got to know. Now I say that it's like, how many of you are selling gold right now? I'm not selling gold. So I had a futures contract out to April 24th, and I took like a bonus profit on that. I pulled in $1.20 per contract, closed it for $1.40. That was a nice little income trade, and that was actually I mean, in a way, it was calling the top mechanically with an options trade, but I'm glad I'm out of the trade because we have gone up another, 100 points, which was fine because my threat level was 3250, so it wasn't really a big deal. But um, I'm curious what that'd be trading for if I was going to be under any pressure. Otherwise, I'd have a bull trap and it would have been like potential $600 winner instead of a $140 winner. But um, I am I'm really curious to see like what retail traders are trying to do. Um, I just don't think this is the train that you want to fight right now. I don't think calling the top on gold is smart at all. If you're trying to be somewhat aggressive on trading gold, okay, then at least wait for a trend line to break. And I know that's not easy. I've been there. I've traded all sorts of anticipation. I've traded all sorts of what I think is going to be the top, but it depends on the instruments that you're trading. You know, so gold, it's like, okay, well, what makes it a top? Well, all I have to say that this could be a topping area would be I have price making fresh highs and I have momentum disagreeing with that. So I have divergence. If I go to a macro picture like this and look at gold, is there anything that tells me this should be going down? Okay, so we have RSI overbought. We have money flow that is starting to show some peaking, which is interesting. I see a little bit of divergence on my MACD histogram. That's about it, though. That's about it. So remember, overbought does not mean signal. Okay. Divergence on MACD does not mean signal. I would say at the very least, we'd want to see a crossover with the signal line in MACD and possibly, at least a candlestick or at least some type of price action suggesting that the bears have done something. Okay. And if we see money flow making a lower high, that's another indication that, okay, things might be exiting gold. But a trend line break could be the easiest way to save yourself the trouble of calling a top when, look, you're going to get a chance to sell this. This is not an exaggeration. I will make a claim that I think by the end of 2025, we are going to hit this 200 moving average. Okay. And I say that because if we go all the way out here, I can go in the future and say, okay, let's go out to, December. How many bars would this bar count be? We have not hit the 200 moving average since October of 2023. This is a 200 moving average. So if we say that's the bar count, I go out to December of 2025. If we don't hit it by the end of the year, that's a 568 bar move, which is insane. That's over 2 years away, right? So we haven't hit it for 2+ years if that's the case. So I'm going to make a claim to say something is going to shift. And I think this is going to be a reversion trade that gives traders an opportunity to short gold like crazy. Okay. But that time is not now, right? Look, if I see the signs of trading gold short, I will short it. I'll trade options. I'll trade it to find risk. Because once it starts, the nice thing is once it starts, this is my destination. There's lots of potential there to make some money. Now, all that's going to help me do is I still have positions of gold where I've bought some shares of GLD. I've traded options. I'm looking at something back in the futures market. So I can trade GC. I can trade GLD. Okay, I can trade a lot of things, but those are my two preferences for if I want to short something in options. I'll take it a finer stab at it, see if I can get the direction right. But I want to wait for better signs to get the technicals and the price action to line up where I think that it's a higher probability win. Because the flip side of this would be that this stretches and stretches and stretches and starts to go almost exponential. I looked at this yesterday in my final session for the day. Orange juice has crashed hard. Cocoa has crashed hard. Eggs have been all over the place. Like the futures market's been wild and crazy with these booms and busts. And gold is, in the I'd say like the fifth, sixth, seventh inning of a run that I don't know when that ninth inning is. I don't know when the game is over. But at some point, this percentage move away and this bar count is going to equal a reversion trade that will be really good. The same reason that I was short the S&P this year was that exact alignment. The same reason I was short the Nasdaq, the same reason I was short Meta and Tesla and Costco and Walmart and Palantir and Carvana, like all these growth stocks that had these crazy stretches and these long bar counts away from the 200 moving average, all of them lined up. And guess what? Pretty much all of them hit. So gold is now on tap for being that similar trade. Okay. So the reason I'm not calling the top is because I get it. There's a lot of bid right now. I wouldn't be surprised if this runs into some type of crazy capitulation move first before the market actually crashes gold. So that's why I'm saying it's silly to call the top right now, unless you have confirmation. Look, a trend line like that could keep you out of trouble. If we're lucky, we have consolidation, right? If we're lucky, we have consolidation, but I could still see more bid. But a better sense of I don't know. I don't know if the tariff stuff has anything to do with it. It's probably a bigger story in the dollar than anything else. Right now, it feels like the world is kind of making a more of aggressive and more intentional play on moving away from the dollar, trying to at least optically. And gold is the true store of value. We've seen Bitcoin be pretty resilient. Not obviously we're not at all time highs at Bitcoin, but pretty resilient in the wake of the markets dropping and having all this uncertainty. So dollar alternatives seem to be doing pretty well. Okay. All right. That's gold. Silver. I still like silver. Chart alarms are set. The nice thing about silver, in my opinion, is that we have not made all time highs yet. So to me, this is an attractive trade because it's cheaper, number one, and the potential rally point. I mean, I can measure the highs at $47. I can measure that price has been there in the past. I mean, that's 41% away. I don't know if gold's going to move another 41%. But if silver hits all-time highs, that's a really nice target to go after. But if gold, stretches another 41%, I mean, who knows where that price is at? What's 41% on gold from these levels? I mean, it's got to be a massive move, right? 41% would be gold's up to $4,400 or higher. Cool. But does it do it? Does it? I mean, I don't know. Anyway, I like both of them. I think gold and silver both good plays this year. Gold is just getting a bit overstretched, where I'd like to see some type of correction so I can add some positions. I truly want to be a gold buyer, but I just want to add at tactical levels. I need pullbacks. I need corrections. I need something. I need consolidation. I need anything. My least favorite trade is just buying highs, buying highs, buying highs. Okay. All right. Bitcoin at 85. We're still green. That's probably encouraging. We need more time to just maintain posturing above 75K and time to get on the right-hand side of the trend line. This could be a good sign for the bulls to step back in, right? I could still see, making lows, getting a little bit scary, but their consolidation level or even a falling wedge could be a good looking sign for Bitcoin, maybe. The problem with Bitcoin now is it is still tied to risk on, risk off trading. And like I said, it's been an impressive amount of resiliency. Yes, it is off the highs by a decent amount, right? But the drawdown has been, I'd say, relatively light compared to most Bitcoin standards. It's down about 30%. Arguably, the market down 5%, 10% has created 40, 50, 60, 70% pullbacks in Bitcoins in the past for the last, 10 plus years. So 30% is pretty well contained. We could still have about a 40 to 50% correction and still not really do any major technical damage here. But I think the big line in the sand for Bitcoin is around 70K. If we break below 70K, that's not good. Unless it's a bear trap, 70K or lower is not a good look for Bitcoin. So I'd like to see it stay above 74, 75K. I'd like to see it stay off these lows and go sideways on the right-hand side of the trend line, give the bulls a reason to rally. I'm sure everyone would be excited to see Bitcoin get back to highs. That'd be a bit of a return to risk on trading, which wouldn't be awful. MicroStrategy as a proxy. Still, I've got expiration of this one, I think out to May, trying to income flip this for a few bucks. Copper. I'm going to see if copper is going to get a bid sooner than later. This has been a really nice run. This trade expires, I think, now or soon. Positions on copper, April 24th. So this is 22 days out. So it's trading about 93% max profit. I'm just going to let it expire. These are all like 0 and 1 deltas. So this is likely going to be full profit. Okay. Japanese yen. If we get a pullback on Japanese yen, I will start looking at position for 6J again. I'm going to hold my FXY positions long. DAX is pulling back a little bit. We could see more gains in the European stock market if we get some clarity out of the U.S. stock market. In fact, I mean, let's say that the U.S. Celebrates this tariff clarity and the U.S. markets go back up. I think this move in the U.S. would be good to show global economy resiliency. We could probably see a renewed interest in trading DAX, renewed interest in trading China. There's been a lot of outperformers that are non-U.S. I mean, like pretty much all of Europe has beat U.S. this year. China's beat U.S. this year. Some parts of Latin America, Brazil's beat U.S. this year. So that is a good sign. And I think if we have at least some optimism of the U.S. market not going dramatically lower, then I think these maintain, this kind of bullish posture. I said this week. If the U.S. market dips aggressively lower, Europe's going to get pulled on with it. China's going to get pulled on with it. The global economy is going to quickly tighten up. You're going to see a run for the exits. Liquidity is going to be getting more drained, and outflows will be more prevalent than inflows. Okay. Fez, that is Eurostock ETF. FTSE, still pretty well supported. I personally like DAX a little bit better. Argentina, I want to see it hit this 200 moving average. China still slightly fading off that fresh high for the year in March. Here's Brazil, want to see it get above the 200 moving average. ILF Latin America, same thing, above the 200 moving average. MAGs, if you want to see some risk on trading, you're probably going to want to see MAGs go up. Again, even if this is a flag opportunity, high to low, even if this is a flag position, okay, that works. So cheering on some MAG 7, even in the short term, that's going to help provide some posture to the market. The technical concern with this would be that MAGs is continued to get rotated out of. If it continues to slide lower, the saying is that flags fly at half mast in the markets. So you take this move here and you measure it. So if you want to see a severe buying opportunity, but also a struggle bus on the MAG 7, it's going to be this. You take this high to low swing for that flag, and let's say that whatever March 26th high we put in is the high. You measure this move out. MAGs to me would not be a buying opportunity unless we're under $40. So I would say, you know what? I position for that at $40 with recent highs on MAGs all the way up to 58. Now, longer term, that's a good trade. But there's clearly a big rotation out of it. That is 50% to the upside to get back to those all-time highs. I mean, if you look at the companies themselves, I still like them. I still like Apple. I still like Amazon. I still like Google. I like Meta. I like Microsoft. MAG 7 is still a good play. If we see the valuations at attractive levels again, these companies all make a ton of money. Fundamentally, they're still as strong as ever, right? I mean, there's a sentiment correction, there's an overconcentration correction, but fundamentally, these are still very strong companies, right? So we'll see. But it's obviously a painful lesson to see, like, the market, and it's been talked about and telegraphed for months before it was actually happening. Many times in 2024, we were talking about the 30+% concentration in 10 stocks, 30+% concentration in 10 stocks. It was all over the place in 2024. So it was a combination of end of the year, seasonality, what happens to a new year in 2025, necessary rotation, and then you throw tariffs on top of that, some uncertainty in the new administration, and here we are. Market has a nice little haircut. Now the question is it a correction, or is it something getting worse? Right? We don't know. So a 10% move is a correction, right? I mean, we had almost 11% in the S&P, 15+% in the Nasdaq. That's a correction, as long as the bulls start to show up. But it's a correction that can quickly slide into a deep correction that can quickly slide into a potential bear market if we cross those 20% thresholds. Okay. All right. Tesla's still hanging out at 263. I'm probably not going to press my luck on Tesla, and I'm just going to let it get called away this week. I say that, but I could probably push into earnings a little bit. So earnings is the 29th of April. If we see a bullish day tomorrow, right? Let's say that everyone gets all excited, the market's up with gap higher. If we can maintain a gap higher on Thursday and close higher with Tesla, I'll probably roll this out for another call and try to pull another $200 to $300 per contract. And if I can, I've got 300 shares of Tesla. So if I can pull another $2 to $3 of credit, make another $600 to $900 in profit on that trade by holding an extra week with a strike at 247, I'll do it. So anyway, I'll make that assessment like Thursday to Friday. This hopefully is going to give us a little bit more clarity for better, for worse, once the tariff stuff is out there, then the market can do whatever it wants. We do have non-farm on Friday. I don't see the markets like immediately reacting negatively to non-farm payroll, but nobody knows. But Tesla, it's above 247.50. That's where I need it to be. I'm not trying to play this like, oh, I'm going to hang on to it long term. I'm not. I've got a bunch of income trades on Tesla that are worth another couple $1,000s if I just see it above 255. That's all I need. So if I took the shares, dumped the shares, and avoid assignment on the other ones, I've got, I don't know, probably for the 3 accounts that I'm primarily trading on, probably close to $8,000 to $9,000 in maybe a 3-week turn, which isn't bad. So yeah, I'm not like long-term anything right now. I'm trading for income. I think that's the best place to position. If we get like crazy discounts, this would be the market flushing lower. Then I'm talking long-term positioning. But for right now, I'm just going to continue to battle. Okay. All right. Berkshire Hathaway sitting near all-time highs. I also want to look at the bond market. We're trading at 91.67. I've got calls in April at 92. So I bought a deep in the money call. It's deep in the money call. Let me check this one on TLT. So TLT is a 65 by 92. As the end of the month approaches, I may look to roll this out and up because I have this all the way out to January 2027. So my goal realistically for TLT is that I would like this, if it's going to get called away for a diagonal spread, I'd like it to get called away as close to 100 as possible. That's my TLT target. Now, I could also just buy shares of TLT and sit with a yield, right? Where TLT yields about 3.65. I still think there's some work ahead with like, what about the Fed? What about rate cuts? How does this affect it? I mean, if the Fed cuts early, which I don't think they necessarily will, the right now the expectation is June, but if the Fed cuts early, I still think the bond market and the yield market react adversely, just like it in September. We can go to the 10-year yield, which I was kind of excited to see the 10-year dropping. This is when the Fed cut in September last year. The yield market did the exact opposite. My concern is that if the Fed comes out emergency swinging for cuts, that this is going to go higher again. Okay. And that doesn't look good for bonds. If yields go up, bonds go down. So I think the issue here is like the 10-year yield going lower. I thought initially for the 10-year to go lower. I mean, I suppose it plays out 2 ways. One is the market tanks and the 10-year drops because everyone is scared. And there's no more consumption. The pause button is hitting across the board. And so what happens? Well, the 10-year drops. Well, the government gets what they want. The Fed sees this is encouraging because we're finally back down to some respectable levels, and the Fed can probably start looking to cut. But emergency levels and doing things that kind of manipulate this, that's my concern, is that we do something that ends up making the 10-year, the long end of the curve rally and get steeper. That's my biggest concern, is that this doesn't follow, this didn't follow what 40 plus years of monetary policy have done. When the Fed goes into a cut cycle, yields don't go up. And yet they did that last year. The market sniffed out that this Fed is doing something. This is a misstep in policy. And the Fed, I mean, really, that's why the Fed is so reluctant to cut this year. So anyway, let's see here. Shah's asking a question. What's that say? Close to an option trade early, partial profit. Is there a penalty for waiting for expiration? No, I mean, if you're trading American options, you can do whatever you want. You can get out of the trade early. You can exit whenever you want. I mean, that's typically what I do. So the option contract it's pretty black and white. You get in, you've got risk and reward. You can let it go all the way to expiration. There are levels you would need to be aware of. For example, I mean, if you want to give me an example, like, hey, I'm buying this call option or this put option or whatever trade you have on, then we can talk through it. But the only way that we'd have any assignment risk, it depends on the spread. But I'll just give you an example. If I do like a bull put spread on the SPY. So let's say that for today, I could do a 0 DT today, which means it expires today. If I had let's say, I'll do this. Let's say I put in a bull put spread. So I sell a 559 put and I buy a 558 put, right? So I'm going to sell. So it's a -1 at 559 put, and it's a +1 at 558, right? And let's say that credit spread is going to pay me about 30 cents. Okay. So if I collect 30 cents, that means I'm risking 70 cents. If price is here, 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 as long as it's greater than 559, I'm going to keep my 30 cents, end of day, closes automatically. If price is all the way down here below my strikes, I'm going to lose 70 cents, closes automatically. The only time I need to be mindful of closing out my trade by expiration would be if I'm inside the strikes, where this sell put level would be a potential assignment of that underline. So if you're going to assign shares of a stock or assign shares of an ETF like the SPY, if it's inside the strikes, this means that when you're less than 559, then the broker is willing to assign you because you're expressing that I'm willing to own at least 100 shares at that 559 strike. And when price is below that, you could have this exercised at expiration. So if we're inside our spread, then we want to close the trade out. We probably get a break-even trade or better-ish. But if it's above, as long as it's greater than 559, there's no assignment risk. You keep your credit. If we're below both of them, then this can expire worthless. There's no assignment risk. That makes sense? So hopefully that's just a quick look at, there's levels to know, but I mean, options are pretty straightforward when it comes to, if you have to do anything like pre-expiration, um, best way to have some success in options would be, have a percentage target. If I've got, a lot of what I do is selling credit. I sell premium, I collect credit. And a lot of what I do is if I have $1 credit and I'm up, 80, 85, 90% of that credit, rather than waiting all the way to expiration, I'm just going to take that profit, move on. Because for me, the capital efficiency is rather than waiting all the way to expiration for that extra 10 cents, I'll just take the 90% and move on. And I do that a lot. So a lot of my trades, when I close out at like 75, 80, 85, 90+% of my profit targets, I just move on because I don't want to wait an extra 20 days or 30 days and hope that it stays where it's supposed to be. If it's offering me profit, I want to see it. Okay. All right. Speaking of, let me check something really quickly here as we're getting closer to expiration. All right. Still down to some XSP trades, but watching. So my key level this week is going to be 560. If XSP stays above 560 and 559, those are all good. Hopefully that is the case. All right. I'll do a little bit more. Let me get through. We did gold, silver, did Bitcoin, went through the international markets, Mag 7, we did the yields. So TLT, I'm watching TLT, SPX here, and then TLT. So I'm actually curious if I just took a little chunk in all of these. I mean, if the Fed does start cutting this year, I'm curious if it's the short end or the long end of the curve that starts to move, right? If the Fed starts cutting rates, is it the 1 and 3 year bond that's going to start to rally, or is it the 7 to 10 year, or is it the 20 plus? The concern is that it's the long end that's going to be the yields go up if the Fed starts cutting rates. So I mean, I almost think that for me to have some better diversification this year, I probably need to have some exposure. I mean, look, the 1 to 3 year is a almost 4% yield. The 7 to 10 year about 3.6. The 20 plus year 3.65. I mean, as far as diversification, I mean, it's fine. I've still had this lingering concern that something's going to break, and I don't know if it's the equities market or if it's the bond market. I don't think I think if the market breaks, it's because we're dealing with a nasty drawdown. The market goes into a nasty drawdown. The Fed doesn't do anything, or the Fed steps in too early, and the market. It's like I do have some legitimate concerns about being overly positioned in bonds. I'd almost rather have corporate bonds in my portfolio. I'd rather have Apple corporate bonds that pay 3%, but Apple's good for it. There could be some weird. I mean, this could be years away, but still, I don't know. Maybe just a little mix. Maybe define risk. Maybe just doing some call options. That could be fine. That'd be better than like holding the shares and getting my butt kicked. Or I buy the shares and I have collars on these positions, where if it gets called away, cool. But a collar position that has a long put and a sell call. So if it gets called away, it's with price appreciation. If the price goes down, then I'm at least protected to the downside. So probably something very boring, but also very safe in the bond side. And then yield is fine. If I have an allocation that averages about 3.6, 3.7%, it's fine. So I don't know if I allocate, I've got $1.4 million of cash to trade with. If I did I would probably no more than like 20% of my portfolio in bonds. So what would that be? Not the whole portfolio, but let's do, I've got 14 there. Let's do 20% of that. So 280 grand. That's a lot of bonds. I personally don't love it. I feel like I'm just going to see lack of performance. It's safety, yes, that could be lowering the volatility overall, but I don't love it. I mean, TLT is a good play. I'll keep working that a little bit, but I want to get on the shorter end just in case these actually have better performance once we start to see a Fed cut cycle. Pound yen, nah. I mean, unless you're a scalper, that's your day-to-day price action on pound yen. I've seen the only successful traders I've seen with pound yen has been scalpers, just because there's good volatility every day. Otherwise, yen pairs across the board, I pretty much, unless I love the setup, I don't trade the yen that much. So I'll trade 6J, I'll trade FXY. That's my exposure. I like 6J quite a bit actually because it's just an options trade for me. Define risk, so I don't have to worry about all the negative swap and all the nonsense with radical irrational movement on the yens. So yeah, my lesson learned on fighting the yen for, I don't know, in 2012 I didn't fight it. I made a ton of money. In 2013 I did fight it, lost some money. 2022 I did fight it. I had to take 9 months to build myself back into a break-even position, as I did well elsewhere. But the yen is just a pair that it doesn't trade like a currency. Like I've learned, currency trading for me is efficiency, pivots, technicals, pockets, efficiencies, liquidity, right? Like that's the forex market. The Japanese yen behaves like a stock. When it gets a destination, it goes so frantically that you don't get any pullbacks. It's nothing but flags. It's pushes and pauses and pushes and pauses, and it works bullish and bearish. So if you're on that side as a trend follower, it's great. But good luck finding that trend once a year. So you get like a 1 month trend or 2 month trend out of a 10-month waiting game. So again, I know some scalpers that are very good on pound yen because that's what they focus on is intraday levels, and it's the pair can move in a given day. You can probably find 50 to 100 pips somewhere in there, but then you got to pick your battles, and it's a 24-hour market. Who knows what hour it's going to be best? So it's just a lot of work for a currency pair that I think behaves very weirdly compared to what I like to trade. I like to trade efficiency. I like to get into pairs that I'm not worried about the market going against me. In a Japanese yen, if it's going against me, I have no idea when it's going to stop. So that scares you on the end. All right. Anyway, I'll start wrapping up here. I think we're about good. Talked about the 50-day moving average on the S&P and the Nasdaq. Market breadth wise, still not offering like a broad buying opportunity, not yet. One way to look at this is NDFI for the Nasdaq and this is S5FI for the S&P. Look at the monthly chart. I want to end on this today. Okay, this for the monthly chart. Here's why I think it's important to, if you have the patience and the presence of mind to kind of keep this in the back burner at all times, if you're wondering for a time to get in the market, look at every time this is touched on the month. Every time it touches on the month, it goes higher. Okay. And so I think what's encouraging is if you have the patience to line this instrument up and look at these, even if they're short-term buying opportunities, okay, when it hits, it goes up. When it hits, actually, it came crashing down to it, and then it bottomed out, and then a month later, it was ripping higher within 2 months. It hits, it settles back. I mean, that's a big move to the upside in the short term, and then it rips a month later. It hits and goes up, hits and rips the entire month, hits and rips the next month. I mean, this is kind of wild that it somehow hits and rallies for that month, hits and rallies a month later, hits and rallies a month later. Point is that it may not be perfect, but I think if you give yourself 30 to 90 days, you're going to see some pretty extreme bullishness when you can time the market at these lows. I know that's a long window, right? But 30 to 90 days, look, if and I'm saying 30 to 90 because if it doesn't cooperate immediately, then wait. But within 1 to 3 months, if we have to like bottom out for a month, indecision for another month, and then rip the following month, well, there's a month, there's a waiting game for a month, and there's a rip. So within like 30 to 60 days, you're starting to see the benefits of that positioning. That makes sense? So this is one thing that's going to be one of my timing indicators for if we have another flush lower, that within a 30 to 90 day window, I think we've got a good opportunity to be very bullish on the market. But that's going to come with potentially, a lot more pain and flushes lower that we could be talking about discounts of, indexes down 15%, 20%, 25%. And it's scary, and it's it's going to be difficult to navigate. That's why I'm trading for income right now. I'm not heavily positioned on really anything, just taking stabs and incomes. It's all defined risk. But I do like, I just saw this yesterday on the monthly chart. I'm like, well, that's a good indication that if you're willing to wait for a month or two, that the payoff is pretty substantial. So anyway, food for thought. So that's NDFI for the Nasdaq and S5FI for the S&P. Again, if we hit this level, 30 to 60 days, markets tend to be very responsive to that. And that gives the market time to settle in. It's not going to be the bottom necessarily, but within reason, I think within 30 to 90 days, you're going to get some pretty good reactions. So that is why, I mean, to me, the definition here is dry powder. If I have cash to deploy, that is a good time to use it. It has paid pretty well as far as time in the market over, this goes back to 07. So, I mean, for nearly 20 years, it's been a pretty good timing indicator. So, all right, that's it for me today. I'll let you go. Thanks. See you tomorrow. Or not. Are we streaming all day today, fellas? What's going on? I don't think this is a marathon at 4 o'clock, is it? That'd be setting a new record. But anyway, Chandler James, you guys can. I'm good. Release me.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.